So if I told you the world just, reportedly solved one of its most explosive geopolitical crises.
Right.
And at the exact same time, the most anticipated space company in history debuted at a mind-bending $2 trillion valuation.
Yeah, you'd think Wall Street would be popping champagne, right?
Exactly. I mean, the headlines are basically screaming that the water is fine, jump on it. But if you actually look under the hood, the data is telling us that the smartest money in the room is, they're quietly locating the exits.
It's the ultimate split-screen reality right now.
Yeah.
You've got retail traders experiencing this intense FOMO, fear of missing out because of these massive headlines. But meanwhile, the institutional algorithms and the seasoned desk traders, they're looking at that exact same news and seeing massive structural traps.
Which is exactly why we're doing this deep dive today. We've got a really sharp, energetic daily market brief sitting in front of us. It's pulled directly from the BTG trading desk note.
Oh yeah, they did a great job breaking down this incredibly euphoric Monday session. June 15th, 2026.
Yeah, a wild Monday. And our mission for you, the listener, is really simple. We're going to cut straight through the noise of this euphoria. We're going to map out the underlying mechanics. And most importantly, we're laying out the exact price levels you need to watch.
Right.
And look, we need to emphasize this right at the top. Nothing we discuss here is financial advice or a recommendation to buy or sell.
None of it. Our goal here is just to give you the blueprint of how the market is functioning right now. I mean, we analyze the mechanics and the order flow, but ultimately, you have to manage your own risk.
Always. So let's lay out the three massive catalysts that are colliding to create this manic Monday session. First, you've got a reported U.S.-Iran peace framework.
Massive news.
Second, SpaceX hitting the public markets. And third, we've got a looming Federal Reserve meeting on Wednesday.
And what's fascinating here is the crucial thread tying all three of these events together. Almost none of the news driving today's price action is settled fact.
Wow.
Yeah, the market is reacting to reported claims, unverified off-feed data, and, forward-looking assumptions. When the headlines are unverified like this, the only truth you can rely on is the observable price action on the charts.
That makes total sense. So let's unpack the geopolitical piece first, because this U.S.-Iran peace framework is, it's dominating the global feeds right now.
It's everywhere.
According to our source video, the headline terms look like this. A halt to military operations on all fronts, including Lebanon. The Strait of Hormuz reportedly reopens this Friday. The U.S. naval blockade is lifted. And there's a 60-day window to hammer out the really complex nuclear and sanctions details.
Right.
Oh, and a formal signing ceremony slated for Friday, June 19th in Switzerland.
See, if you're an algorithmic trading bot programmed to scan news feeds for positive sentiment keywords, that headline is just a massive buy signal.
Oh, for sure.
It triggers an immediate influx of automated capital. But human traders look at that exact same text and immediately spot the structural cracks.
Well, before we dig into those cracks, I need to pause and just be completely transparent with you listening.
Yeah, good call.
The sources we're analyzing contain politically charged claims involving U.S. and foreign leaders. In this deep dive, we take absolutely no political sides, neither left nor right. We are strictly reporting the claims as they appear in the source material to convey how the market is reacting.
Right. We're not endorsing any of these viewpoints.
Exactly.
Because at the end of the day, the market doesn't have a political party. It only cares about liquidity, risk, and reality. And the reality of this framework is deeply contradictory.
It really is. Reading through these details, it feels like two people walking out of the exact same movie theater, but describing completely different films to you. How do the U.S. and Iran have such wildly different reads on the same 14-clause text? Let's start with the money. Iran is claiming that Washington approved a $300 billion rebuild package, plus another $25 billion in unfrozen assets.
But the U.S. side flatly denies this.
Right. But then the source noted that J.D. Vance gave a soft hedged acknowledgement on CBS, saying Iran could access funds if they hold up their end. So what does a soft hedge mean for the market?
It means uncertainty. A soft hedge on a Sunday talk show is not a confirmed $300 billion wire transfer.
Yeah, not quite.
That is a staggering amount of capital that could dramatically impact global currency markets and inflation data, yet nobody can agree if it actually exists.
And then we get to Clause 9, the nuclear clause. The source points out that it essentially just restates Iran's existing non-proliferation commitments.
Right.
There's no new enrichment cap, no dismantlement of current facilities, and there are no new inspectors on the ground.
Which means the status quo is basically being repackaged as a breakthrough. The market priced in a permanent de-escalation, but the actual mechanics of the deal leave the nuclear capabilities entirely intact.
I hear that, but let me play devil's advocate for a second. If the shooting stops, isn't that still a massive win for global stability? I mean, let's look at the Israel wrinkle.
Okay.
The source reports that Netanyahu told Trump that Israel will not withdraw from Lebanon, which reportedly prompted a very frustrated reaction from Trump. Wait, how can the market price this in as a comprehensive peace deal if a key military actor isn't even bound by the terms?
That is the exact cognitive dissonance we're talking about.
Yeah.
Algorithms buy the word peace, but the structural reality is that a primary participant is visibly opting out of a core clause. And the contradictions don't stop there. Look at the shipping lanes.
Oh, right, the Strait of Hormuz. Trump framed this as a toll-free reopening for global shipping, but Iran is openly claiming sovereign authority to collect what they're calling service fees after that 60-day waiver expires.
Calling it a service fee is just a diplomatic rebrand of it all. And you have to remember, the Strait of Hormuz is the single most important shipping choke point in the global energy market.
Right.
If one nation suddenly has the authority to tax a massive percentage of the world's daily oil supply, that fundamentally alters global inflation models.
So the takeaway for the listener who is feeling the urge to buy into this global rally is that this is not a ribbon-cutting ceremony. It's a 60-day ticking clock on a highly fragile, deeply contested negotiation.
Exactly. You have to separate the headline from the mechanics. The market is pricing in the best-case scenario of day 60, while we are only on day 1 of an unverified roadmap.
Which brings us perfectly into the second catalyst, because if you think geopolitical headlines require a massive filter, corporate news happening completely off the live feeds is even wilder. Let's talk about the euphoria surrounding SpaceX's market debut.
Oh man, this is a masterclass in market structure anomalies.
The numbers being reported by the source are just eye-watering. The claim is that the ticker, SPCX, ran up 20% today to $194 a share. That implies a $2.5 trillion market cap, which would instantly make it the sixth largest public company in the world, casually stepping over Taiwan Semiconductor.
If you're listening to this, you're probably wondering why you can't just open your brokerage app and buy a share.
Because you can't. And that is the massive reality check here. On the actual verifiable trading feeds used by the desk, SpaceX is still a privately held company.
Right?
The numbers driving this euphoria are entirely source described. They are not flowing through the standard public tape.
But people are trading derivatives around it, which feels incredibly dangerous. The source notes that options open tomorrow. If the underlying stock price isn't even verified on the public feed, how on earth do you price an option?
You price it with a metric called implied volatility, or IV.
Ugh.
Because the hype is so astronomical and the verified data is literally zero, the market makers selling those options are going to crank the implied volatility through the roof to protect themselves. Let me translate that for a second. When implied volatility is through the roof, it essentially means the options are so expensive that you can correctly guess the stock will go up, but still lose money because you vastly overpaid for the ticket in the first place.
That is exactly how retail traders get crushed. They buy the hype, but they don't understand the pricing mechanics.
Yeah.
And we are already seeing this destruction in the leveraged products. The source reports a 2x long ETF ticker, SPCH, is up over 30%, while the 2x short SSBC is reportedly down 35%.
Hold on, that math doesn't make sense to me. If the reported stock is up 20%, shouldn't a 2x leveraged ETF be up exactly 40%? Why is it only up 30%?
Because of a mechanism called volatility drag or beta slippage. Leveraged ETFs rebalance daily.
Yeah.
In a pre-IPO frenzy with massive unverified intraday swings, that daily rebalancing effectively eats away at the fund's capital.
Wow.
You're bleeding value simply by holding the asset in a choppy environment. It's a structural trap for anyone who thinks it's just a simple multiplier.
Okay, so what about this forced buying thesis the source brought up? The narrative is that the price has to keep rocketing because index funds are legally required to buy it. How does that mechanical demand actually work?
Well, when a company reaches a certain size and is added to a major index, Every mutual fund and passive ETF that tracks that index has to buy shares to match the new weighting.
Right.
They don't care if the stock is undervalued or overvalued. Their mandate is simply to mirror the index.
And the source claims there is a rule change allowing SpaceX to be eligible for the NASDAQ 100 in just 15 days and the Russell indexes in 5 days. The S&P 500 is reportedly about a year out because that requires a verified history of profitability.
So is there literally a wall of institutional money forced to buy this stock?
That's the thesis. But here is the vital distinction you have to make. This is mechanical forward demand.
Meaning?
It's an assumption about flow that might happen in 5 or 15 days. It is not confirmed buying happening today. The market is pricing tomorrow's potential mechanical flow into today's unverified price.
Well, if there's a delay in that index inclusion, the air pocket underneath this valuation is massive.
Man. So if the geopolitical headlines are full of contradictions, and a $2.5 trillion company is trading on unverified tape, where do we look for the actual verifiable truth?
You zoom out and look at the only genuinely verifiable chart on the board, the S&P 500 ETF, ticker SPY.
Right.
And you have to look at those levels in the context of Wednesday's absolutely critical catalyst.
The Federal Reserve. We've got the FOMC meeting this Wednesday, a 2 p.m. rate decision, followed by a 2:30 p.m. press conference. And the enormous wild card here is that this is the debut of the new Fed chair, Kevin Warsh.
Yeah, this is where the mechanics of macro risk really come into play. The source notes a major repricing claim happening right under the surface of this rally.
What are they repricing?
The market is flipping from pricing in rate cuts to actually pricing in rate hikes, largely due to the potential inflationary pressures of this Iran conflict. They're currently eyeing the first hike for December 2026.
So if the market is sitting near all-time highs, why on earth would institutional money start pricing in rate hikes? That feels completely backwards to a euphoric rally.
Because institutions look at the data, not the cheering on deck. And the data the source shared about new Fed chairs is deeply sobering.
Tell me.
Historically, markets despise the uncertainty of a new chair. The statistics show the market is, on average, down 4.6%, 2 months after a new chair's debut meeting.
Wow, almost 5%.
Yep, it's down 4% at the 3-month mark. In fact, the market is only green 37.5% of the time at that 3-month window.
Is that just because markets hate uncertainty, or is there a structural reason new chairs drag the market down?
It's kind of a rite of passage. A new Fed chair has to establish credibility instantly. If they come out dovish and accommodating, sure, the market might rip higher, but inflation expectations could earn more.
Right.
They almost have to come out hawkish, crushing some of the market euphoria, just to prove to bond vigilantes that they take inflation seriously.
Which brings us to the exact precise numbers on SPY. If you are listening, this is where you grab your Post-it note. We need to map this out so you aren't treating on emotion.
Definitely.
SPY gapped up hard on this Iran news and is currently sitting less than 1% under its all-time high. Let's look at the ceiling first.
The overhead supply zone is really clear.
The 760 all-time high zone is the ultimate ceiling. Just beneath that, you need to watch 758, which was the early June peak from June 4th.
Yeah, 758 is the immediate hurdle. If the bulls want to maintain any semblance of control heading into Wednesday's Fed meeting, they need a clean, sustained reclaim of that 760 area. Otherwise, it is just a lower high in a topping pattern.
But the downside is where the trapdoors are. The first floor of support is 752. The next floor is 750. Why is 750 so critical? Is it just because it's a nice round number?
No, it is a massive psychological and algorithmic zone. 750 is the line where trading bots switch their programming from buy the dip to liquidate exposure. The source emphasizes that if 752 and 750 are lost with conviction, the safety net is gone. The gap fill target is all the way down around 740.
An air pocket from 750 down to 740 right before a hawkish Fed chair debuts. That's scary. And let's contextualize this broader environment. The market has been green 10 of the last 11 weeks. It is incredibly stretched.
Extremely.
On top of that, 2026 is a midterm election year, which historically guarantees heavy seasonal volatility in the back half.
And corporate earnings are practically non-existent this week. We only have La Z-Boy reporting tomorrow and Regressive on Wednesday.
Meaning there are no corporate fundamentals to distract the algorithms. We just have two binary events, an unverified geopolitical deal and a hawkish Fed meeting driving a highly valued tape with a zero fundamental cover.
It is an environment that actively punishes emotional trading, which is why we need to look at where the capital is rotating.
Let's run through the specific watch list from the desk. If institutions are terrified of 750 breaking, they aren't just sitting in cash, they're rotating. And I'm going to emphatically remind you again, these are exact levels to watch, not green lights to buy or red lights to sell.
Right.
Let's start with gold, ticker GLD. And the level to watch is 410.
So GLD has been in a brutal downtrend, pulling back about 24% from its highs, but it just popped 2.4%. 410 is the structural trigger line.
Break down the mechanism there. Why does a push through 410 matter?
It's all about short seller pain.
Okay.
When an asset drops 24%, a lot of institutional money bets heavily against it. 410 is the line where those short sellers start taking unacceptable losses.
Ah, I see.
If the price breaks through 410 cleanly, those institutions are forced to buy shares to cover their short positions, which creates an explosive mechanical upward feedback loop. It would immediately trigger institutional interest in silver and the gold miners ETF, ticker GDX.
Next on the list is HIMS. It bounced 12.5% today, but it is still down more than 50% from its February 2025 all-time high. The levels to watch here, 30 needs to hold as the floor and 32 is the line to break.
This is a classic technical setup. The source notes a possible wedge pattern resolving. 30 is the line in the sand where buyers have historically stepped in. 32 is the ceiling of that wedge. If it breaks 32, the technical algorithms take over and push for upward momentum.
Then we have Western Digital, ticker WDC. It tagged an all-time high near 655 today. Intraday, it actually hit 658.80 after reclaiming that 600 to 620 shelf. The level to watch for continuation is a clean break above 660.
The chip sector has been defying gravity, but WDC specifically built a massive consolidation shelf between 600 and 620.
Right.
By breaking out of that, it absorbed all the historical selling pressure. So 660 is the blue sky breakout line.
What if this whole euphoric tape rolls over? If the Iran deal falls apart or Warsh comes out incredibly hawkish, where does the big money hide?
The Consumer Staples ETF, ticker XLP. This is the ultimate risk-off rotation. Because the mechanics of human behavior don't change during a market crash. Even in a war or a recession or a rate hike cycle, people still buy toothpaste, toilet paper, and groceries.
That's true.
We're talking about companies like Walmart, Costco, Procter & Gamble, Coke, Philip Morris. If you see XLP spiking while SPY is dropping, that is your signal that institutional money is rotating into defense.
And for the traders looking at fast movers, the momentum names. DoorDash, ticker DASH, watch 169 for upside continuation. Red Cat Holdings, RCT, watch 12 for the upside. And Momentous, ticker MNTS, watch for a breakdown under 10.
If you're watching these momentum names, you must understand the mechanics of risk. You have to use strict stop losses.
Definitely.
These stocks have low floats and high retail participation, meaning they move incredibly fast and they do not care about your portfolio. A stop loss is an automated order to sell if the price drops to a certain level. It's really your only defense against a sudden algorithm-driven liquidation.
Now, here is where the institutional flow gets genuinely weird. The source flagged a highly unusual options anomaly. They call it a smart money anomaly.
Yeah, this was wild.
Someone threw down a $1.5 million trade in Estée Lauder, ticker EL. But they didn't buy the stock. They bought the 115 strike calls dated all the way out to January 21st, 2028.
Right.
Let's translate that for the listener. The stock is currently sitting around $65. By buying a 115 strike call, they're essentially buying a lottery ticket that only pays out if the stock almost doubles over the next year and a half. Why lock up $1.5 million on an out-of-the-money bet for a makeup brand that is down 75% from its highs?
That is what makes this an option sweep anomaly. This isn't a retail trader gambling. This is an institutional player positioning for a massive structural regime change in the company's fundamentals.
Wow.
They're betting that the bleeding has stopped and a multi-year turnaround is beginning.
But the source threw in an incredible piece of narrative gossip to go along with it.
Oh, yeah.
Jane Lauder, an heiress to the company, is reportedly married to the brand new Fed chair, Kevin Warsh. Are we seriously suggesting that the new Fed chair's wife's company just saw a highly unusual bullish options sweep right before his very first FOMC meeting?
Okay, let's ground this immediately. It is a fascinating narrative association, and, human beings love to connect dots like that.
Oh, of course.
But it is absolutely not a mechanical trading signal. Gossip does not provide support or resistance.
Exactly. You can't execute a trade based on a cocktail party rumor. What does the actual chart say?
The verifiable chart shows that EL recently bounced off a very firm multi-year support floor at 65. Buyers defended that level aggressively.
Okay.
But the psychological and structural line that actually flips this stock back into institutional favor, the line that starts putting those 2028 calls into the money, is 120.
A long way to go.
Right. Until the price crosses 120, this entire options flow is just an interesting anomaly, not a confirmed trend.
All right, let me synthesize this entire deep dive for you listening right now, because the cognitive dissonance out there is just deafening. We have competing, highly contradictory narratives on an Iran peace deal that is operating on a 60-day ticking clock.
Yep.
We have completely unverified off-feed euphoria driving a $2.5 trillion valuation for SpaceX, creating structural traps and leveraged ETFs. We have a potentially historically hawkish debut for a new Fed chair on Wednesday, with institutions already repricing for rate hikes.
It's a lot.
It is. And bridging all of this chaotic reality together are the exact SPY levels you need to watch. Overhead resistance ceilings at 758 and 760, critical algorithmic support floors at 752 and 750, and a looming dangerous air pocket down to 740 if those floors break.
If you're listening to this and feeling the urge to open your brokerage app to chase these trillion-dollar headlines, just take a breath. The tape is specifically designed to induce panic buying. This is why having those exact levels written on a Post-it note next to your monitor is your absolute best defense. By trusting the mechanics of the numbers rather than the emotion of the unverified headlines, you manage your own risk.
Yeah.
You do not trade the story. You trade the verifiable reaction to the story.
Which brings us back to the core mantra. Do your own work and manage your own risk.
I want to leave you with one final thought to ponder based on the cross currents in these sources. We know the market is currently stretched within 1% of an all-time high.
Right.
We know it's facing deeply conflicting geopolitical narratives and a new Fed chair debut that historically crushes market euphoria. So what exactly happens to the structure of this market when that fragile 60-day Iran negotiation clock runs out, at the exact same time the notoriously volatile 2026 midterm year seasonality begins?
The sun is shining, the market is cheering on deck, but the radar is screaming that there is a reef dead ahead in 60 days. Keep your eyes on the instruments. Thanks for joining us on this deep dive.